exactly what would have happened. We would have invested an additional $15 billion, and 3G would have invested an additional $15 billion if a friendly agreement could have been reached. So if the deal had been made, if the independent directors of Kraft Heinz had approved the transaction, then the likelihood is that we would have invested $15 billion, but it would have required the approval of the independent directors as well. Now, Kraft Heinz, in going forward with making that offer, wanted to be sure that there would be enough equity capital in addition to the debt that would be incurred to make the deal, and so informally we had basically committed the $15 billion. It only was approved on the basis that it'd be a friendly deal with Unilever, and initially we thought they would be at least possibly interested in such a deal, and when we found out otherwise, we withdrew the offer. So it would have been $15 billion of additional money in all probability. Okay, station 5.
Dear Honorable Mr. Buffett and Mr. Munger, I'm Tian Dehua from China. My company, AI Holdings, is spreading value investing philosophy in Asia. My business partner, Ken Chi, Zhou Guiying, and I are committed to awake 100 million Chinese people to return to rational way of investing. The hardest thing in this world is to change people's values or belief system, and we should like to awake investors to change from speculate in the market to investing in the market. It's like changing the speculators' values or belief system. May I ask you, Mr. Buffett, can you kindly advise us what we should do to spread your value investing philosophy, or is there any word of encouragement? Thank you.
Yeah, when in any system, Keynes wrote about this in 1936, I think it was, in the General Theory, or 35, I think it's chapter 12. It's a great chapter on investing, and he talked about investment and speculation and the propensity of people to speculate and the dangers of it, and worded eloquently. There's always the possibility of, there's always some speculation, obviously, and there's always some value investors and all of that sort of thing in the market. But when speculation gets rampant, and when you're getting what I guess Charlie would call social proof that it's worked recently, people can get very excited about speculating in markets, and we will have it from time to time in this market. There's nothing more agonizing than to see your neighbor, who you think has an IQ about 30 points below you, getting richer than you are by buying stocks, and whether it's internet stocks or whatever, and people succumb to it, and they'll succumb in this economy just as elsewhere. There's also a point which gets to your question. I would say that early on in the development of markets, there's probably there's some tendency for them, I think, to be more speculative than markets have been around for a couple of hundred years. Because markets have a casino characteristic that has a lot of appeal to people, particularly when they see, like I say, people getting rich around them. And those who haven't been through cycles before are probably a little more prone to speculate people who have experienced the outcome of wild speculation. So basically in this country, Ben Graham was, in the book I read in 1949, was preaching investment, and that book continues to sell very well. But if the market gets hot, new issues are doing well, and people on leverage are doing well, a lot of people will be attracted to not only speculation but what I would call gambling. And I'm afraid that will be true in the United States. And I think that China, being a newer market, essentially, in which there's widespread participation, is likely to have some pretty extreme experiences in that respect. We will have some in this country too. Charlie?
Well, I certainly agree with that. The Chinese will have more trouble. They're very bright people. They have a lot of action, and sure, they're going to be more speculative. And it's a dumb idea. And to the extent you're working on it, why, you're on the side of the angels. But lots of luck.
Well, it will offer the investor more opportunities, actually, if they can keep their wits about them. If you have wild speculation, I mean, Charlie just mentioned earlier, if we get into periods that are very tough, Berkshire certainly will do reasonably well, because it won't, and we won't get fearful, and fear spreads like you cannot believe until you've seen a few examples of it. At the start of September 2008, you had 35 million people with their money in money market funds with $3.5 trillion in them, and none of them were afraid that dollar wasn't going to be a dollar when they went to cash in their money market fund. And 3 weeks later, they were all terrified, and 175 billion flowed out in 3 days. And so the way the public can react is really extreme in markets. And that actually offers opportunities for investors. People like action, and they like to gamble. And if they think there's easy money to be made, a lot of them, you'll get a rush to it. And for a while, it will be self-fulfilling and create new converts until the day of reckoning comes. So just keep preaching investing, and if the market swings around a lot, you'll keep adding a few people here and there to a group that recognizes that markets are there to be taken advantage of rather than to instruct you as to what is going on. Okay, Andrew, do you have any more on that, Charlie?
We've done a lot of preaching, Warren, without much effect.
Right. And that's probably good from our standpoint. Okay, Andrew?
Thank you, Warren. This question comes from Ryan Prince. President Donald Trump and his advisors have talked about proposing a substantial investment tax credit to provide incentives for long-term corporate fixed capital investment. In BNSF, Berkshire owns a sprawling infrastructure portfolio requiring regular routine maintenance investment of substantial scale. What impact would an investment tax credit have on BNSF's capital investment decision-making from a return on investment a capital perspective, as well as in terms of timing? And just as importantly, given the current economy and employment picture, would such a tax credit amount to a subsidization of otherwise mandatory maintenance capital investment, or a proper incentive to stimulate investment?
Yeah, well, it would all depend on how it was worded, because we've had investment tax credits in this country, and we've had bonus depreciation. It's another form of it. And we do get extra first-year depreciation. That does not enter into our calculation very much. In fact, certainly at the Berkshire level, I've never instructed anybody to do anything different because of investment tax credits or accelerated depreciation. There may be some calculations done down at the operating company level. It's certainly true in something like wind projects and solar projects. They are dependent on the tax law currently. There may come a time when they aren't, but they wouldn't have been done without some subsidization through through the tax law. But I would say if you change the depreciation schedules and double depreciation, triple depreciation, that we're going to do what we need to do at the railroad to make it safer and more efficient if we just had ordinary depreciation. And I doubt if there'd be any dramatic differences. Obviously, if you were going to, say, buy a bunch of planes and the law was going to change on December 31st and the math made it better to wait till January 1st or do it this December 31st, you didn't make that kind of calculation. But I can't recall in all the years that I've ever sent out anything to our managers saying, let's do this because the tax law is being changed or might be changed or something of the sort. As I mentioned earlier, it changes just a little bit if you think there's going to be a change in capital gains rates at a given time. Obviously, if the rate's going to be lowered, you would take losses ahead of time and defer gains maybe a little. And that's why it's useful, actually, if the tax committees, the Senate and the House, are working on something, it might be useful if the chairmans would say that if we do make any changes, we're likely to use this effective date or something of the sort. And I think they've done that a few times in the past. We are not the big tax-driven item is in wind and solar, and that is a specific policy because the government has decided they want to move people, or society has decided they want to move people toward those forms of electric generation, and the market system wouldn't do it. And there may come a time when the market system will do it all by itself. We won't make big changes, and it's so speculative anyway in terms of even what the law would be. But beyond that, if it becomes less speculative as the law, I mean, it really looks like something is going through, it doesn't change us big time at all. Charlie?
Nothing to add. We're not going to change anything at the railroad for some little tax jiggle.
If we need a bridge repaired, we're going to repair the bridge, and if we need a lot of track maintenance all the time and that sort of thing, and it just I don't think Matt and I have ever had a talk about it since we've owned the railroad. But Greg?
Warren, my question also relates to Burlington Northern. Despite the current administration's belief that they can bring the coal industry back, market forces continue to lead to the industry's demise. While 90% of U.S. coal consumption is driven by electricity generation, natural gas has been both cheaper and cleaner burning, and renewable electricity generation has remade parts of the market as wind and solar have gained scale and become cheaper alternatives. This has created problems for Burlington Northern, with coal shipments accounting for just 18% of volume and revenue for the railroad last year, down from an average of 24% for both measures the previous 10 years. While some of this was due to a large buildup of coal supplies the past couple of winters, which finally seem to be working their way out, what are your expectations for the contribution coal can make to BNSF longer term? And I know that the railroad currently handles some export shipments going through Canada's Pacific Coast ports, but will there be enough growth there to offset domestic demand, or will BNSF need to rely more heavily on segments like intermodal to offset lost coal volumes?
Yeah, the answer is coal is going to go down over time. I don't think there's much question about that. The specifics of any given year relate very importantly to the price of natural gas. I mean, right now the demand is somewhat up, a fair amount up from last year because natural gas is at $3.15 or $3.20, and the utilities can produce electricity in many cases quite a bit cheaper with coal than with natural gas. Whereas with the $2, it would be natural gas. But over time, coal is, in my mind, is essentially certain to decline as a percentage of the revenue of the railroad. The speed at which it does, you don't create generation plants overnight, and so you can't predict the rate. And if natural gas is cheap enough, it's going to be you'll see a big conversion back to natural gas. So coal is going to go down as a percentage of revenues significantly. Certainly over 10 years it'll be quite significant, and who knows exactly year by year. We are looking for other sources of growth than coal. If you're tied to coal, you've got problems. Charlie?
Well, if you go out over the extremely long term, I think that all the hydrocarbons will be used, including all the coal. So I think that in the end, these hydrocarbons are a huge resource for humanity, and I don't think we've got any good substitute. And I've never minded saving them for the next generation. I don't like using them up very fast. So I'm off on a little road on my own on this one. And people think that all this hydrocarbons are going to be stranded and the whole world's going to change. I think we're going to use every drop of the hydrocarbons sooner or later. We'll use them as chemical feedstocks. I regard all these things as very hard to predict, and I'm not at all sure that. I would eventually expect natural gas to be pretty short in supply.
A change in storage would make a big difference. We will produce, within a few years, as much electricity in Iowa, or virtually as much electricity in Iowa from wind as our customers use, but the wind only blows about 35% of the time or something like that, and sometimes it blows too hard. But the storage, having it 24 hours a day, 7 days a week, is a real problem, even if we've got the capability of producing, like I say, a self-sufficient amount, essentially, in Iowa before very long. Coal, our shipments of coal are up fairly substantially this year on the BNSF, but they were very low last year, and as you said, stockpiles grew and have come down somewhat. They're still on the high side. But in my mind, Charlie's got a longer-term outlook on this. In my mind, we're going to be shipping a whole lot less coal 10 or 20 years from now than we are now. On the other hand, I think there's some decent prospects in other long hauls. I mean, it's a pretty cheap way to move bulk commodities long distance. Rail is, and I think it's a good business, but the coal aspect of it's going to diminish. Okay, station 6.
Hi, good morning. Good morning. It's Marcus Burns from Sydney, Australia. My question, Mr. Buffett, is: you used to buy capital-light, cash-generative businesses, but now buy lower-growth, capital-consumptive businesses. I realise Berkshire generates a lot of cash flow, but would shareholders have been better off if you had continued to invest in capital-light companies?
Well, we'd love to find them. I mean, there's no question that buying a high return on assets, very light capital intensive business that's going to grow beats the hell out of buying something that requires a lot of capital to grow. And this varies from day to day, but I believe, and I don't think it's sufficiently appreciated, I believe that probably the 5 largest American companies by market cap, and some days we're in that group and some days we aren't. Let's assume we're not in that group on a given day. They have a market value of over $2.5 trillion. And that $2.5 trillion is a big number. I don't know whether the aggregate market cap of the U.S. market is, but that's probably getting up close to 10% of the whole market cap of the United States. And if you take those 5 companies, essentially you could run them with no equity capital at all. None. That is a very different world than when Andrew Carnegie was building a steel mill and then using the earnings to build another steel mill and getting very rich in the process, or Rockefeller was building refineries and buying tank cars and everything. Generally speaking, for a very long time in our capitalism, growing and earning large amounts of money required considerable reinvestment of capital and large amounts of equity capital. The railroads being a good example. That world has really changed, and I don't think people quite appreciate the difference. You literally don't need any money to run the 5 companies that are worth collectively more than $2.5 trillion and who have outpaced any number of those names that were familiar if you looked at the Fortune 500 list 30 or 40 years ago, whether it was Exxon or General Motors or you name it. So we would love, there's no question that a business that doesn't take any capital and grows and has, almost infinite returns on required equity capital is the ideal business. And we own a couple of businesses, a few businesses that earn extraordinary returns on capital, but they don't grow. We still love them, but if they were in fields that would grow, believe me, we would, they would be number one on our list. We aren't seeing those that we can buy and that we understand well. But you're absolutely right that's a far, far, far better way of laying out money than what we're able to do when buying capital-intensive businesses. Charlie?
Yeah, the chemical companies of America at one time were wonderful investments. Dow and DuPont sold at 20 sometimes earnings, and they kept building more and more complicated plants and hiring more PhD chemists, and it looked like they owned the world. Now most chemical products are sort of commoditized, and it's a tough business being a big chemical producer. And in comes all these other people like Apple and Google, and they're just on top of the world. I think the questioner's basically right that the world has changed a lot, and that the people who have made the right decisions in getting into these new businesses that are so different from the old ones have done very well.
Yeah, Andrew Mellon would be absolutely baffled by looking at the high cap companies now. The idea that you could create hundreds of billions of value essentially without assets, without tangible assets. Fast, yeah. But that is the world. There is when Google can sell you something that where Geico was paying $11 or something every time somebody clicks something, that is a lot different than spending years finding the right site and developing, iron mines to supply the steel plants and, railroads to haul the iron to where the steel is produced and distribution points and all that sort of thing. Our world was built, when we first looked at it, our capitalist system basically was built on tangible assets and reinvestment and all that sort of thing, and a lot of innovation and invention to go with it. But this is so much better if you happen to be good at it, to essentially be able to build hundreds of billions of market value without really needing any capital. That is a different world than existed in the past, and I think it's a world that's likely to continue. The trend is. I don't think the trend in that direction is over by a long shot.
A lot of the people who are chasing that sort of thing very hard now in the venture capital field are losing a lot of money. It's a wonderful field, but not everybody's going to win big in it. A few are going to win big in it.
Okay, Carol?
This question is from a shareholder in California, in the Silicon Valley area, who didn't want his name mentioned because he said he wasn't looking for publicity, but whose picture makes him appear to be a millennial. Every Berkshire shareholder knows about the stock market value of Berkshire. But my question is about the value of Berkshire to the world. For instance, the value of Apple to the world has been iPhones. The value of GEICO is cost-effective auto insurance. The value of 3G, and I will tell you that there aren't some shareholders who would be arguing about here, but the value of 3G is improved operations. But about Berkshire, I just don't know. In managing Berkshire's subsidiaries, as Mr. Munger once famously said, you practice delegation just short of abdication. So hands-on management can't be the answer. That means the majority of Berkshire's subsidiaries would do just as well if they were to stay independent companies. So that's my question. What is the value of Berkshire to the world?
Yeah, well, I would say the question about I'm with him to the point where he says that, which he accurately describes as delegation to the point of abdication. But I would argue that abdication actually, in many cases, will enable those businesses to be run better than they would if they were part of the S&P 500 and the target perhaps of activists or somebody that wants to get some kind of a jiggle in the short term. So I think that our abdication actually has some very positive value on the companies, but that you'd have to look at it company by company. That we've got probably 50 managers in attendance here, and naturally they're not going to say anything publicly on television or anything where they knock us or anything, but get them off in a private corner and just ask them whether they think their business can be run better with a management by abdication from Berkshire, but with also all the capital strengths of Berkshire, that when any project that makes sense can be funded in a moment without worrying whether the banks are still lending like in 2008, or whether Wall Street will applaud it or something of that sort. So I think our hands-off style actually, I think, can add significant value in many companies. But we do have managers here you could ask about that. We certainly don't add the value by calling them up and saying that we've developed a better system, for turning out additives at Lubrizol or running GEICO better than Tony Nicely can run it or anything of the sort. But we do we have a very objective view about capital allocation. We can free managers. I would say that we might very well free up at least 20% of the time of a CEO in the normal public who would otherwise have a public company, just in terms of meeting with analysts and the calls and dealing with banks and all kinds of things that essentially we relieve them of. So that they can spend all of their time figuring out the best way to run their business. So I think we bring something to the party, even if we're just sitting there with our feet up on the desk. Charlie?
Yeah, we're trying to be a good example for the world. I don't think we'd be having these big shareholder meetings if there weren't a little bit of teaching ethos in Berkshire. And I've watched it closely for a long time. I'd argue that that's what we're trying to do, is set a proper example. Stay sane, be honest. Yeah. So I'm proud of Berkshire, and I don't worry too much if we sell Coca-Cola.
I would say, GEICO is an extraordinarily well-run company, and it would be extraordinarily well-run if it were public. But it has gone from 2.5% of the auto insurance market to 12%. And part of the reason, the small part, the real key is GEICO and Tony Nicely, but part of the reason is that when at least two of our competitors, big competitors, said that they would not meet their profit objectives if they didn't lighten up their interest in new business 8 or 10 months ago, I think our business decision to step on the gas is a better business decision, but I think that GEICO as a public company would have more trouble making that decision than they do when they're part of GEICO, because we are thinking about nothing but where GEICO is going to be in 5 or 10 years. And if that requires having we want new business costs to penalize our earnings in the short term. And other people have different pressures. I'm not arguing about how they behave, because they have a different constituency than GEICO has with Berkshire and what Berkshire has with its shareholders in turn. And I think in that case our system's superior. But it's not because we work harder. Charlie and I don't do hardly anything. Jonathan?
Could you please talk about your periodic payment annuity business? The weighted average interest rate on these contracts is 4.1%, which doesn't sound particularly attractive given the current interest rate environment. Is the duration of these liabilities long enough to make that an attractive cost of funds, or were these contracts executed primarily when rates were higher?
Well, those contracts, these are what are called structured settlements primarily. And when somebody young has a terrible auto accident or whatever it may be, perhaps urged by the court, urged by family members who really do have the interest of the injured party at heart, they may convert what could be a large sum settlement, probably against the insurance company, maybe $1 million, maybe $2 million, into periodic payments for the rest of the life of the injured party. And we issue those for other insurance companies. In fact, sometimes the court directs that Berkshire or hints strongly that Berkshire should be the one to issue those, because you're talking with somebody's life 30 or 40 or 50 years from now, and the court or the lawyer or the family may want to be very, very sure that whoever makes that promise is going to be around to keep it, and Berkshire has a preferred position in that. We look, to get to your question, Johnny, we look for taking the longer maturity situations. We always have, and we have to make assumptions about mortality, and we have to make assumptions, and then we have to decide at what interest rate we'll do it. The 4.1 is a mix of a lot of contracts over a lot of years, obviously. We write maybe 30 million of these, 20 to 30 million a week, looking for the long maturities. And so if you take an average of 15 years or something of the sort, that's how we come up with that sort of a figure. We adjust them to interest rates at all times. We're making an assumption that we're going to earn more money than is inherent in the cost of these structured settlements. It's a business I think we've got 6 or 7 billion up now, and we'll keep doing them. And incidentally, probably a significant percentage of the 6 or 7 billion we're not yet paying anything on. Somebody else may have the earlier payments, and they're certainly weighted far out. So it's a business that we'll be in 10 or 20 years from now. We've got some natural advantage because people trust us more than any other company to make those payments. And the test is whether we earn over time a return above that which we're paying to the injured party. And that's a bet we're willing to make. But if interest rates continued at present levels for a long time, we would, assuming we kept the money in fixed income instruments, we'd have some loss in that. We've got an allowance in there for the expenses, incidentally, because we do make monthly payments to these people eventually, and we have to keep track of whether they're still alive or not, because you cannot count on the relatives of somebody that's deceased when a check is coming in every month to notify you promptly that the person has become deceased. But that number will go up over time. If interest rates stay where they are, that 4.1 will come down a little bit as we add new business. Okay, station 7.
Thank you, Mr. Buffett and Mr. Munger, for all you've done and the opportunity to learn even more from your approach to investing in life. My name's Harry Hong, and I'm a respirologist from Vancouver, British Columbia. The question involves, back in 2001, you made an initial investment in USG shortly before the company declared bankruptcy due to the mounting asbestos liability. You held those shares through the bankruptcy process, even though standard wisdom says that the equity in Chapter 11 is usually worthless. Can you explain why USG's equity was a safe investment?
Well, I don't really remember all the details then.
It was very cheap.
Very
cheap.
Yeah, but I would say this. USG, we own, I'm not sure what percentage, but it's a very significant percentage. I don't know,
20% or something.
Probably 30% or something like that. But the USG overall has just been disappointing because the gypsum business has been disappointing. And I think, I may be wrong, I think they went bankrupt twice, first from asbestos going back and then subsequently because they just had too much debt. So it has not been a brilliant investment. Now, if gypsum prices were at levels that they were in some years in the past, it would have worked out a lot better.
But it hasn't been terrible.
No, it hasn't been terrible. But gypsum has taken a real dive several times, and there has been too much gypsum capacity. And then when it comes back, the managements have been, not necessarily at USG, but including USG perhaps, they've gotten more optimistic about future demand than they should have. And they like, going back historically away, they like to build new plants. And it's a business where the supply has been potential supply has been significantly greater than demand in a lot of years. I mean, you've seen housing starts and since 2008 and 9 not come back anywhere near as much as people anticipated. So gypsum prices have moved up, but not dramatically. So I just put that one down as not one of our great ideas, not one of my great ideas. Charlie wasn't involved in that. It's no disaster, though.
No, it isn't. It's...
Becky? Oh.
Hello? Oh, there we go.
Okay.
This question comes from Axel Meyerseek in Germany, who writes, if Ajit Jain were to retire or, God forbid, be promoted, what would be the impact on the insurance operations, both with regards to underwriting profit as well as the development of float?
Well, nobody could possibly replace Ajit. I mean, you can't come close. But we have a terrific operation in insurance. We really do. Outside of Ajit, and it's terrific squared with Ajit. There are things only he can do, but there are a lot of things that are institutionalized, a lot of things in our insurance business where we've got extraordinarily able management too. So Ajit, for example, bought a company that nobody here has heard of probably, called Guard Insurance a few years ago, based in workers' comp primarily. It's based improbably in Wilkes-Barre, Pennsylvania, and it's expanding like crazy in Wilkes-Barre. And it's been a gem. And Ajit oversees it, but we've got a terrific person running it. And we bought Medical Protective some years ago. Tim Kennedy runs that. Ajit oversees it, but Tim Kennedy can run a terrific insurance company with or without Ajit, but he's smart enough to realize that if you got somebody like Ajit that's willing to oversee it to a degree, that's great. But Tim is a great insurance manager all by himself, and Medical Protective has been a wonderful business for us. Most people don't know we own it. The company goes back into the 19th century, actually. We've got a lot of good operations. If you look at that section in the annual report called Other Insurance Company. I mean, that is, in aggregate, that is a wonderful insurance company. There's very few like it. Geico is a terrific company. Ajit has made more money for Berkshire than I have probably, but we've still got what I would consider the world's best property casualty insurance operation, even without him. And with him, nobody. I don't think anybody comes close. Charlie?
Well, a few years ago, California made a little change in its workers' compensation law. And Ajit saw instantly that it would cause the underwriting results to change drastically. And he went from a tiny percent of the market, like 10% of the market, which is big, and he just grasped a couple of $1 billion at least out of the air, like was snapping his fingers. And when it got tough, he pulled back. We don't have a lot of people like Ajit. It's hard to just snap your fingers and grab a couple of $1 billion out of the air.
But we actually, the California workers' comp, the Guard has moved into that. We have got a lot of terrific insurance managers. I mean, I don't know of a better collection anyplace. And Ajit has found some of those. I've gotten lucky a few times. I mean, Tom Nerney at U.S. Liability, that goes back, 15, 16 years. He is a terrific operation. It's not huge, but it is so well managed. And people don't even know we own these things. But you look at that last line, and now we've added Peter Eastwood with Berkshire Hathaway especially. And these are really good businesses, I got to tell you. When you can produce underwriting profits and on top of that just hand more float, we don't have many businesses like that. Those are great business. We've got 100 billion plus of money that we get to earn on, while at the same time, overall, on balance, we're likely to make some additional money for holding it. If you can get somebody to hand you $104 billion and pay you to hold it while you get to invest and get the proceeds, it's a good business. Now, most people don't do well at it. And, the problem is that what I just described tempts lots of people to get into it. And recently, people have got into it really just for the investment management. It's a way to earn money off. We don't do that, but it can be done for small companies with investment managers. So there's a lot of competition in it. But we have some fundamental advantages, plus we have, in certain areas, plus we have absolutely terrific managers to maximize those advantages. And we're going to make the most of it. I've just been handed something Kraft Heinz came out with. They just came out with it commercially a few days ago, maybe a few weeks ago. At the directors' meeting, they had this. I had 3 of these. I'm sure that there's a member or two of the audience that may not approve of it, but they. I got to tell you, folks, it's good. It's a cheesecake arrangement with topping and Philadelphia cream cheese special on. So you create your own cheesecake. And I thought that I can eat it while Charlie's talking, and you'll be able to get it at the halftime. It's selling very well, and I think, just so you don't feel too guilty, I think it's 170 calories for this cherry one. Like I say, I had 3 of these. I don't mind having 500 or 600 calories for dessert. I'll let somebody else eat the broccoli, and I'll have the dessert. So we'll be eating this, but you too, at halftime. I think they brought 8,000 or 9,000 of these. I'll be disappointed if we don't run out. Actually, I'll be disappointed in you, not them. Okay. Jay?
This question is on the topic of succession planning. Warren, there seems to be fewer mentions by name of top-performing Berkshire managers in this year's annual letter. Does this mean you're changing your message regarding the succession plan for Berkshire's next CEO?
Well, the answer to that's no. And I didn't realize there were fewer mentions by name. I write that thing out and send it to Carol, and she tells me go back to work. I don't actually think that much about how many personally get named. I would say this, and this is absolutely true. We have never had more good managers. Now it's because we've got more good companies, but we have never had more good managers than we have now. So but it has nothing to do with succession. Charlie?
Well, I certainly agree with that. We don't seem to have a whole lot of 20-year-olds.
Certainly not at the front table.